Carvana stock's been on a wild ride over the last few months. After soaring to record highs in 2021, the stock has plummeted more than 80% this year. However, back in July, they did something called a debt restructuring where they paid down some of their debt, which sent their stock price going way up. If you look, you'll actually see that Carvana stock is up 991% year to date. So is Carvana stock actually a buy now? That's the question I'm going to answer in this video. I'll break down the debt reduction and explain what it means for Carvana's future. I'll also look at the stock evaluation and give you my opinion on whether or not it's a good investment. So if you're thinking about buying Carvana stock, or if you're just curious about the company, then this video is for you. But first of all, what is Carvana? What do they do? Well, if you've seen those car vending machines that actually have the cars stacked up like little Legos or little Tonka trucks, that's actually what they do. So they're an online used car retailer based in Tempe, Arizona. They were the fastest growing online used car dealer in the United States, especially back in 2021 during the pandemic when production and manufacturing went down and used car prices absolutely skyrocketed. Their ticker symbol is CVNA, not to be confused with Canva, but this is actually Carvana, CVNA, and they trade on the New York Stock Exchange. So in terms of what we're going to be going over today, like I said, we're going to go over the debt reduction, how that actually helped their stock, what I think of the stock, and would I purchase it again. Now, anything that's went up 991% year to date is probably set to decline a little bit. I wouldn't expect to see 991% gains on the stock again over the next year. So that's number one. Be careful with that. If I look at the stock and what it's done this year from a notable event, and I'll link this down in the description. This is from Google Finance. Back in July 19th, their stock did surge 40% after they restructured their debt. But what does that mean? Well, if I look here in this article, you'll actually see that they talk about the car vending machine, the close the day trading up 40%. They'll reduce their outstanding debt by $1.2 billion, meaning they paid off some of their debt through the Apollo Group. They made an agreement between their note holders, and 80% of Carvana's 2025 and 2027 unsecured note maturities lowered their cash interest expense $483 million per year over the next 2 years. That's big stuff. So in layman's terms, what does that mean? If you owe debt, your debt to income ratio is going to go up. Even if you're a normal consumer, say you have multiple mortgage on your house, you have multiple auto loans, that's going to affect the debt to income ratio of you when you actually go to get a loan, you go to refinance a loan, or you're just trying to, do daily things where you need credit. As you pay down your debt, even as a normal consumer, your credit rating tends to go up. You have more debt, that's okay if it's the right kind of debt, but if it's debt that's at a higher interest rate, or it's debt that's impacting your debt to income ratio or the book value of your company, even the price to earnings ratio of your company, that's all bad. And you'll look here, it even talks about Carvana's been struggling financially in recent months because of declining used car prices. Obviously, we've been able to start manufacturing more cars since COVID's quote unquote over. We're able to manufacture more cars, we're able to get more people on the road, we're able to drive those prices back down. So a company that is in business selling used cars is not going to do well when interest rates continue to go up as well as manufacturing goes up. When supply is very tight and constricted and interest rates are low, they're able to sell more. But they've, again, hit two factors: rising interest rates on auto loans, and manufacturing has definitely increased. If you look at this, a relatively new player in the car field, they lost money most quarters since they went public in 2017. Yeah, if I go back and look at the 2017, they IPO'd, let's go back here. They IPO'd at $11.10, and they actually went down below that in the beginning. And then if you go out to look out here, January 20th of this same year of 2023, they were trading at $6.49. And during the COVID, they were trading at $349. Now, for a company that opened their IPO at $11.35 and in less than 4 years had went up to $360 a share, that's unsustainable. I almost think that's borderline. I don't want to call it financial engineering, but I would definitely have a look at their books and look at their income statements. This, going back to this article, they talk about the strong performance of the business in 23 presented an opportunity for an impactful win transaction for Carvana and the unsecured note holders. Well, obviously, so what they did was the stock price went up as they announced that. Then they were able to buy back stock and pay off some of their debt by making sure that they knew when they were going to pay off that debt, and to their note holders, their stock would end up and going up. So the 30 to 40% surge was predominantly held by them just basically paying off debt. They also announced quarterly earnings revenue beating expectations. That helped as well. It sold fewer cars than forecasted, and they're up a whopping 1,000% a year ago. One other thing about Carvana, they launched 10 years ago, but they didn't IPO till 2017, so that would have been 2013, and they spent about 4 years private. And, I haven't personally used Carvana. I've seen them driving around locally, but I don't really have a lot of experience with them. Now, if I go over here, this is another one, sort of the Wall Street Bets GameStop part of it. There was a big short position in Carvana stock over the last 6 to 8 months. And what that means is a short position is there's people that are making a bet that the stock will go down. And as the stock continues to go down, they make money. However, if the stock goes up, the losses could be infinite and they may have to buy back the shares at a premium from somebody who actually holds them. This article talks about how the nice run they've had, 892%, 1,000%, somewhere around there. But there was, like I said, a huge short interest in this. Their second quarter of this year was interesting. So revenue down 24% to 2.97 billion. Net loss down 76%. Gross profit per unit up 94%, and adjusted earnings 155 million. So it looks like they were pleased with the results and the execution of the business. I think it's more so about them paying off their debt and looking more to their balance sheet and understanding that Carvana in its current state can do extremely well as long as they're paying down their debt, and obviously they're exceeding the numbers to the street. But in early 2022, Carvana lost 33% of its value when Wedbush cited a risk of bankruptcy. So if I go back to December of 2022, let's go back an entire year. I'll go back into, where is it? Yeah, here's December, 547, 42.28 down to $4.16. Yeah, that's where you'll actually see it. You'll see a big volatile move there. And then as they actually did better, they beat their number, a smaller loss, the outlook got a lot better. The article, if I go back here again, you'll see a risk of bankruptcy. But notice also too, Bloomberg reported that creditors who controlled about 70% of Carvana's unstructured debt had agreed to act together in negotiations. So 70% of their debt was held by a couple debt holders, and one of those is actually Apollo Group. So the deal prompted Wedbush to set a dollar price for Carvana that was then trading at $4, citing bankruptcy concerns. Basically, it looked to Wedbush that they were unable to pay their debts, which would result in foreclosure, which would result in bankruptcy. In November 22, Carvana faced numerous problems, and some of those still persist today. So declining industry demand. Demand was softening for Carvana and CarMax and large new and used vehicles such as Lithium Motors and AutoNation. The 24% decline in Carvana's second quarter revenue suggests this is still an issue. Yeah, obviously there is declining demand because car prices continue to go up. So if you hold this stock, you have to understand that as long as interest rates are high and these companies are able to continue to produce cars, there won't be a short supply of inventory like there was 2 or 3 years ago when everything shut down. Now that COVID's basically gone and we're able to produce to the quantities or even exceeding the quantities that we did pre-pandemic, the industry demand may continue to decline. So that's something to watch out for. The other one is gloomy forecast. So they're not optimistic about this year. 23 is a difficult one. He told investors cars are expensive, discretionary, often finance purchases that inflated much more than other goods in the economy. In the short term, the forecast is not improving. Carvana's retail units sold fell 35% to 76,000 from the year before. But again, that's things I've already talked about. Why is that happening? Well, interest rates are higher, discretionary income's going down, the COVID money's gone. And one thing that a lot of people aren't talking about, but I have been, is the student debt problem. Student debt repayment is about to go into effect next month in October, and when that happens, you're actually going to see demand fall even further down because student debt loan is not one you can write off in any kind of bankruptcy, and student debt loan is one that stays on your credit report, where if you file bankruptcy, you can actually get car loans and auto loans taken off when you file Chapter 7 or Chapter 13. Things have improved. The cash position has gotten better because they paid down some of their debt. They're not paying as much on margin, and lower profits from selling loans. I didn't actually know that Carvana underwrote loans, but their profits from selling those loans back has actually decreased. Now, the debt structuring deal, here we go. So they spent about a year working on the deal to restructure its debt. It reduced the debt by $1.2 billion, and the stock rose 40%. The deal will eliminate over 83% of its 25 and 27 secured maturities and lower its required cash interest expense by more than 430 million per year for the next 2 years. Why is that so important? If you can offload some of the debt on your paper and move that out to something else, you can use it for R&D, you can use it for marketing, you can use it for expansion, whether it's human capital or hard capital in warehouses. You can buy more cars, you can get your supply chain and your logistics contracts down, you can restructure that, or you can just simply increase the buyback of stock, which will ultimately increase the price of the stock. The deal covers $5.2 billion of senior unsecured bonds, includes Apollo Group Management as its largest bondholder. I've talked about Apollo Group Management before and investing in secured secondary or tertiary debt. So I'll definitely link a video up here that goes over that if you're interested in private credit and private equity investing. I already did several videos on that. The new notes have very high interest rate. Carvana will not pay the $430 million worth of interest in cash for 2 years. The interest will increase the principal amount on the loan. So basically, they push that out another 2 years, and $430 million on a $2.1 billion revenue company is a lot of money for them. I feel like this stock, along with GameStop and AMC, has been, like I said, a GameStop meme type of stock where people on Reddit continue to talk about it. And if enough people see a short squeeze coming, they're more likely to buy the stock and drive it up like they did with GameStop, costing certain hedge funds and institutional investment